Okay, good morning and welcome back, everyone, or rather, welcome everyone to our first Options Play research webinar that Rick and I are hosting on the Daily Play trading signals. Now, I'm joined here by Rick Bensignor, our Chief Market Strategist here at Options Play, to discuss the Daily Play trade ideas that we send out, and specifically around how to place the trades and provide a forum, if you will, for you as members to provide us feedback and ask questions regarding these trade signals that we send out. But today we want to take our time and go through what we think is one of the more important elements of these trading signals is how do you go about utilizing them for your portfolio and actually placing a trade. So Rick, welcome and good morning.
Morning, Tony. How are you?
I'm doing well. So let's go ahead and get started. But before I do, I just want to reiterate our new options education track that we are now embarking on every single Thursday at 4:15 p.m. If you haven't joined us for one of these sessions yet, I hope that you'll be able to join us here going forward every single Thursday as we walk you through from going from a beginner in the essential track of learning how to trade options all the way through mastery. Really excited to be launching this new course for everyone, regardless of whether you're a beginner or advanced, to be able to learn more about option strategies. But today, what we're here to talk about with Rick is really the trading signals and research that Rick and his team puts out. Now, before we go into this any further, I do want to talk about the important disclaimer here, which is simply the fact that what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we will discuss during today's session. So Rick and I today are going to spend some time and really walk you through, regardless of where you get your idea from, whether it's from Options Play or some other service or you originate it yourself, how do you go about thinking about that idea and how to allocate capital in your portfolio to that idea? In order to do so, I'm going to first start off by talking a little bit about a sample portfolio, or what your portfolio or my portfolio may look like and how it's structured, because that's going to help you determine kind of from a trading decision perspective whether an idea that comes across your desk is one that's worth taking. And then we'll talk about some trading examples for opening a trade and how that would look like for your portfolio, closing a trade and how that would look for your portfolio, and then also talking a little bit about trading during fast moving markets, because sometimes you might get an idea. By the time you're ready to act on it, things have changed a little bit. How can you adjust your trades accordingly, especially the daily play trades, where in a fast moving market, by the time you are looking at entering the trade, markets may move by a couple of dollars, but that doesn't mean the trade's not valid. But it does mean that in order to trade it, you might want to make some adjustments. So I want to talk about how you can make those adjustments and how to place those trades accordingly. And then we're going to open this up for Q&A. This is the forum for you as a member here for Options Play to submit questions that you have regarding daily play. Give us your feedback, and Rick and I will incorporate that feedback and some of the questions that come across into the daily play research and ideas that we put out. So this is not only a forum to learn something, but also provide your feedback and potentially influence the trading ideas that we send out to you. So I'm going to start off by just talking about a portfolio. And Rick, you and I have talked about this quite a bit regarding the fact that even though you and I trade a fair amount of options and different strategies outside of our investments, the bulk of our portfolio is still largely typically made up of longer term investments, whether it's a retirement portfolio where we're not actively trading those particular names, versus a secondary element of our portfolio, which is more discretionary. This is where we do our trading. This could be swing trading ideas, macro ideas, options, futures, Forex. There's a wide variety of different trading, if you will, that customers might trade in their portfolio. But there's really two components of our portfolio that make up our total portfolio. And for the context of today's discussion, we're going to assume, let's say you have a $100,000 portfolio. We're just going to use a nice round number to help illustrate the principles of how you might want to allocate capital from a portfolio from a trade idea that originates here from Options Play. And you really have to think about this from the perspective of you have a choice between your investments and your trading, whether you want to allocate more capital to investments, whether you want to allocate more investments to trading, and depending on your risk tolerance, you might choose one or the other. But the trading aspect of your portfolio, which is what we're going to talk about here today, that really requires active risk management. And Rick, you can jump in here if you would like. Just talk a little bit about how important risk management is to your portfolio, outside of just the idea generation piece.
I'd say, Tony, that from looking at trading, you've got the two most important things to success is both to have discipline and to have skilled money management perspective. And without those, the likelihood of success over a long time is not very high. So when you talk about trade requires risk management, it's very different than if you're investing for the long run. When you're trading something, you have to know how to manage the risk. And that includes using stops, that includes getting out when you hit your targets, or at least taking no less than 2/3 off when you hit your target. And not trying to get the last dollar out, because a lot of times that last dollar costs you everything.
Yeah, and so we'll talk a lot about this concept, and we'll actually host a separate webinar just on that one concept alone. But today we're going to talk about just a set of rules that you could apply to your portfolio, a simple set of rules, such as only allocating a set percentage of your total portfolio to every trade idea that comes across your desk. It doesn't matter where the idea comes from, whether it comes from OptionsPlay, whether it comes from yourself, it comes from CNBC or Bloomberg, no matter where the idea from, you should have a set percentage of your total portfolio that you're willing to risk on a specific trade. And that's what we're going to go through today. So I want to walk you through kind of just the anatomy of a trade and kind of how a trader would go about thinking whether or not a trade that comes across your desk, an idea that comes across your desk, is worth taking. And it really all comes down to risk management and the set of rules. So the first thing I'm going to talk about here is simply just idea generation. You have an idea of an underlying stock, you have a directional view, and perhaps you have an options trade in mind in order to leverage that directional view. So the first thing that you want to do once you have that trade, whether it's originated from you or somewhere else, is to understand the max risk per contract of that particular trade. Now, I'm going to use a nice round number here of, let's say, $500. And you have to understand that depending on the strategy that you're trading, whether it's a debit or a credit, you have to calculate not just the cost of the trade, but what is the max risk of that trade per contract. So you could perhaps trade something for a $100 credit, receive a $100 credit, but take on $500 worth of risk. So it's not just how much credit or debit that you're paying or receiving, but how much risk you're taking per contract. Then what you want to do is calculate the amount that you're willing to risk in your portfolio. Let's say you have a $100,000 portfolio and you're willing to risk 2% of that $100,000 portfolio. That means you're willing to risk on every single trade idea that comes across your desk no more than $2,000. That is a simple math equation to take $2,000, divide by the $500 of the max risk of the trade structure that you're looking for, and that determines how many contracts you can trade. In this particular case, 4 contracts. And what you really have to look at the end of the day is whether the trade max risk, the max risk of the trade, is greater than the portfolio risk amount that you're willing to risk, or is it less than the portfolio risk amount that you're willing to risk. So in this particular case, because I'm willing to risk $2,000 on a trade, and the trade that I'm looking at here is $500, that means I'm actually placing a trade that is risking less than what my total risk that I'm willing to take. Now, you should only trade ideas where the max trade risk is less than what you're willing to risk in your portfolio. Those are the rules that you need to have in place before you go ahead and place a trade. Meaning, if you have a trade that comes across your desk that, let's say, it risks $5,000 per contract, but the 2% of your portfolio is only 2%, that is a trade that you should probably either adjust so that the max risk is under $2,000, or that's a trade you should simply pass on because it's risking too large of a percentage of your portfolio. And Rick, I'm sure you've probably seen traders talk about, hey, this one trade went really bad and I lost a lot of money on that particular trade. And I always, go back to that customer and ask that person who told me this, was it the trade or was it the amount of capital that you allocated in your portfolio that was the problem? And it's almost always the latter and not necessarily the trade itself that was quote unquote bad.
So you have to be, when you play this game, and it is a game, you have to think in terms of long-term survivability. And everything you do has to stick within that concept such that no one loss or string of losses knocks you out of the game. So you can't bet half your portfolio, no matter how sure you are about an idea. You never bet that big on any one idea because it's just one of many. I know that there are, now with crypto being the way it is, there's actually just about 50% of all people in crypto are underwater based upon, let's say, the current Bitcoin price. And I've spoken to people who have half their portfolio in crypto. And I'm like, that's crazy. Because yeah, you may make money, but it also sets you up to lose not everything, but half of your net worth if this goes sour. It's not even a proven idea yet. It's still in the infancy. And to bet that much on anything just doesn't make sense and doesn't fit into the idea that you want to be able to play this game today, tomorrow, next month, next year, and 20 years from now. And you can't do that if you lose half your portfolio on one idea. It'll change everything about how you live your life.
Yeah, and we can talk about this for hours of, the finite versus infinite game, where a lot of traders think about this as a finite game, but in reality, you're playing an infinite game. You're playing for survivability. And when you think about an infinite game, that's kind of where you change your perspective as to what are you trying to do here. So a lot to talk about here, but let's get back to the subject here at hand. I want to go through a real example, a trade structure that we sent out here on March 16th, which was a PayPal trade idea. Rick called the bottom here on PayPal and suggested that you buy a 100-120 call spread. At the time, this was a bullish idea on PayPal, and this bullish call spread was trading at the time at $6.95 per share. That's $695 per contract. And because it was a debit spread, the amount that we're paying was the max risk. So the max risk was $695 per contract. And what I'm going to do is I'm going to assume, again, my $100,000 portfolio, and let's say I'm willing to risk 2% of my total portfolio. And we're going to come back here at a later date to really dive into why the 2% rule is so important. You can risk more, but you start to get yourself into some trouble potentially if you risk more per trade. But let's say you're willing to risk 2% of your account per trade, that's $2,000. That means you can trade a total of 2 contracts and stay below your $2,000 max risk. That comes out to be $1,390 in terms of total risk if you traded 2 contracts. And that's how you should determine, from an idea that's generated here from OptionsPlay or an idea generated from you, how do you allocate capital in your portfolio to that one idea? In this particular case, we would trade 2 contracts for this particular trade. And I just want to walk you through, because it's not like you just have cash sitting around necessarily in order to execute these particular trades or to allocate these particular trades. Sometimes you may be fully invested in your portfolio. And especially if you think about that longer term investment portfolio where you might be long the spiders or Qs or some other index fund. What you can do potentially is sell some shares of SPY. In this particular case, at the time, SPY was currently trading around 430 at March 16th when we entered the PayPal trade. Let's say you sell a little over 3 shares and raise roughly $1,400 from selling those 3 shares of SPY. You use those proceeds to buy the 2 contracts of the PayPal trades, and that's how you fund the trade of that particular idea. And this is something that you can do where you can remain effectively fully invested in your portfolio, but still allocate capital to these trade ideas or discretionary trades when these ideas come across your desk. And you don't have to necessarily have cash sitting aside waiting for these ideas to come across your desk before you place the trade. And then I just want to walk you through, once you've entered this particular trade, how do you look at exiting this trade? And this is really something that we've recently introduced, and hopefully this helps illustrate what we mean by entering half or exiting half the position. So we entered 2 contracts at the time here for PayPal. So at the time on March 24th, yesterday, Rick sent out a second alert for this position saying it's time to start taking some profits. Now, Rick, if you don't mind talking a little bit about why we've started to take half profits as opposed to simply all in and all out, and what is the kind of general philosophy behind that?
Well, trading is made up often of multiple decisions. And, we tend to be much more in the camp of technical trading as compared to trying to do it off of fundamentals. And as such, there are going to be times, look, we bought PayPal when almost everything we do starts with an at the money strike if we're doing a spread. So we bought PayPal when it was trading about 100. And I looked at my charts and I said, where would I be willing to take some off? Where's some resistance? And that's where I often come up with where the other strike is that we used in the spread. So I looked at the 100, 120. We very quickly, within a few days of paying 100, we were trading over 115. And to me, it just made sense to take some off. We made very good money very quickly. It was kind of like the Moderna trade where we got in and it just shot our way instantly. And you want to take advantage of that because you also know there's a max that you can make. So it's not like we bought a $100 stock and if it's trading 150, we can make that much more than if it was trading 120. We capped it at 120. So we know what our maximum gain could be. When you make that much that soon, often I want to take some off. If we come up against, let's say, a daily 9, we're long something and perhaps it makes a daily 9 and I kind of think we're going to pull back or stall there. I don't want to lose too much theta. We could stay there for a day or a week. I might take half off. Trading is not all or none decisions. And I think that one of the things that we've, been able to do recently is show you that you can take a partial profit or a partial loss, get out, change how you're looking at things, but stay within the context of what you're still looking at. So we've taken off half of PAAS, we've taken off half the Moderna trade, we've taken off half of PayPal. And as we get closer to a potential near-term top in the S&P, which I think could come as early next week, I'm going to trim a little bit because I'm not this ultra bull the way some other people are.
Right. And just to walk, and that this is really kind of what's adding to some of the feedback that we've received from members as well regarding being all in and all out. Being all in and all out doesn't give you a lot of flexibility, but when you are exiting half the position, you can actually take quite a bit of risk off the table. In this example here for PayPal, what we did is we sold 1 contract. So we bought 2, but we sold 1 contract here at about $12.62. That brought in $1,200 in credit. That almost virtually pays for the total max risk of the 2 contracts. So we paid $1,400 for the 2 contracts. We collect $1,262 on the single contract. And what we've done is effectively been able to repurchase the roughly 3 shares of SPY that we sold in order to get into this trade. We're now back invested in the market from the proceeds that we raised from selling half the position, but we still own 1 more contract. If PayPal continues to trade higher here, and let's say we hold this towards expiration, and we get PayPal above 120 by the expiration, the maximum value of this spread is $20. So we'd be able to generate a $2,000 credit if we're able to sell this if PayPal is above 120 at expiration. And that's really the goal here of having that 1 contract remaining, is to try to shoot for that larger, almost 200% gain on these types of spreads, because normally if you take the full contract off, then you might have made a nice 80-90% gain, but you don't have that opportunity to get to that 150-200% gain. And that's really what we're able to do and have that flexibility flexibility when we have half a position still on. So hopefully this illustrates to you what we mean when we say put on half the position or take off half the position, is really allocating, either full 2% of your portfolio to a trade, or have only about 1% of your portfolio allocated for that trade at that time. And then lastly, what I want to talk about, this is a common question that we get, probably one of the most common questions that we get, is regarding trading in a fast moving market. We send out a trade signal with a specific price on the underlying specific trade structure, but by the time you receive the signal, by the time you're ready to place the trade, the market has moved. And the question always becomes, is the trade still valid? Now, this is really where, as far as whether the trade is still valid is, there are other factors to consider, but if you still consider the trade to be valid, how can you determine what to trade? So this is really where I'm using an example here. Let's say we have a bullish view on stock ABC currently trading at 105, and we generate the signal when the stock is trading at 105. And we're telling you to buy to open the 100-115 call vertical. This is a $10 wide debit spread. And at the time of the signal that we publish it, it's trading for a $3 debit. So you're buying a $10 wide debit spread for $3. But let's say you don't open this trade idea until 11 a.m. after the market is opened. And by the time 11 a.m. comes by, the stock has already rallied from 105 to 110 or from 105 to 107. And the question is, how do you then adjust your trade if you still want to place this trade, but you see that the market has moved? And many of you may have witnessed some of this type of market activity or price action during the past few weeks where things have moved very fast. So in this particular case, if by the time you are looking at the trade, let's say the stock has moved from 105 to 110, what you can do is you can adjust the strike prices based on the amount that the stocks have moved. So if, let's say we were originally looking at a 105, 115, what you can do is you can adjust the strike prices by the $5 the stock has moved up by. So instead of using the 105, 115, you would use the 110, 120, because the stock has moved $5 higher. You move your strike prices $5 higher. And if you do that, you should be able to place that trade for virtually the same debit. So in this particular case, we were looking at the 105, 115s for $3. If you adjust your strike prices by that same $5, you should be able to place that trade at roughly the same debit price. So that's how you can make adjustments in a fast-moving market. If you happen to be placing the trade at a slightly different price than when we sent out the signal, you can make adjustments because we don't know when you're going to be placing the trade. We don't know how fast the market's going to move on that given day. But these are the ways that you can make adjustments, small adjustments to the trade based on the trade signal that we send out. So remember, shift your strike prices based on how much the stock has moved. And when you do so, you generally can still trade them at the same limit price that we sent you. So with
Tony,
that covers.
Let me ask you a question on that I think a lot of people would ask. Let's say you had a $100 stock, and based on where futures are trading or something, it opens $2 higher. It's not enough to shift up a whole strike, but you may not be able to do the trade at the same price based upon the prior day's close. Is there any way, like how do you think about getting that trade done?
So I would say that if you can try, if you're saying that there is no 102 strike, you can't adjust it to the 102 strike.
5.
Yeah. So if let's say the strikes, there are no strikes that you can adjust it to. Let's say the strikes are $5 apart, but the stock has only moved $1 higher. Then what you simply would do is, let's say at the time this was trading at $3, or let's say the mid market at that particular at the time that we send out the signal was $3. But if, let's say, the stock has moved up $2 at that time, then you're going to see that the bid-ask price might be, the mid price might be $4. So that's really where, if you don't have the option of adjusting the strike prices, you're going to have to adjust the limit price. So what I suggest you to do is look at the midpoint of the spread at that time, meaning the same strike prices, look at the midpoint and use that new midpoint as your new limit price to potentially enter this trade, as long as you still believe that this is still a valid trade. So on a $100 stock, if it moves by $1 or $2, I usually still consider that a more than valid trade. So for example, PayPal, it was trading at $100. If you didn't catch it until 102, I still think that's a perfectly valid trade. So you would still place that trade. You would just use the midpoint at the time you place the trade rather than the midpoint of the signal when we sent it out.
Okay, thank you.
So with that, that covers what I wanted to share with you here today. I hope that this was helpful in walking you through just taking an idea, thinking about how to go about allocating capital in your portfolio and how to go about trading half a position, either getting into half a position or exiting half a position that we send out, because you should expect to see more of that from us going forward so that you can take some profits off the table, but still maintain a portion of the trade to try to hit the trade out of the park, if you will, on some of these types of spreads, especially with the debit spread. In order to make that maximum gain, you got to hold it to expiration. And usually before then, we usually see some opportunities to take some profits off the table. So with that, what I want to do right now is open this up fully for Q&A, for feedback here. There's both a chat window and a Q&A window. So please, I'd love to hear kind of your questions and your feedback regarding the DailyPlay research that Rick and I put out, what your thoughts are on them, any questions that you might have along with these trade signals that we send out, and hopefully, even incorporate some of your feedback and questions into our research going forward.
So I'll tell you that as you've been doing your presentation, I've been answering some of the questions in the chat to people. But there's still a few, I haven't been able to get to all of them. So some you'll see are answered, and you should all look at what those answers are, because a lot of these questions pertain to everybody. But we can, let's take a look at some of these, Tony, and see what we can do. One, for sure, that people wanted to know is what's the near-term outlook for the market? And in my perspective, I'm not thinking the way the ultra bulls are, that we are just going to race to new all-time highs. The bottom we saw on February 24th is likely a good near-term low. It should remain the low as long as things don't get crazy in the geopolitical front, but that's an unknown. So we can't quite play for something else to change at this point. At the same time, the same issues that plagued the market a week and 2 weeks ago before we lifted off, other than that, then we were very oversold and we held all the key levels we needed to, is you still have a hawkish Fed, which you will for quite some time. You still have this Russia-Ukraine crisis, which is not ending, and it shows no signs of ending, and we don't know to what extent Putin may take this and go ballistic on it. So that's certainly an overall headwind. You have inflation that's running wild, and that's going to affect corporate profits. And you have interest rates that are moving higher, and a Fed telling you they're going to continually move higher. So you've got some real headwinds that haven't changed in the last 2 weeks, yet the market's up over 5%. Probably closer to 7% or something like that since we bottomed. So because of that, I'm still thinking that the highs we saw the first week in January, which are the all-time highs, are probably the highs for anything in the short term. And I don't mean the next 2 weeks, but over the next few months. I'm not sure we're going to make new highs. If we do, I have no reason to think they're going to stay the highs. And for right now, I think we've probably made the low that matters, barring something going really awkward or crazy, in the geopolitical front. And don't forget that on the geopolitical front, you've got China versus Taiwan as something that's potentially overhanging the market. And the Chinese, seeing the reaction to what the Western world did on the Russian invasion of Ukraine, may deter them or may not about them going into Taiwan. So these are, the geopolitical side is still something that very much affects and overhangs the market. All of this being said, I'm playing the range that we've seen this year as what's probably going to stay the range for, not saying the rest of the year, but for a while now. So as we rally and get closer towards that early February peak, which was the first bounce off the first low we saw on the big sell-off, we had seen, then I'm scaling out of some long-term held stuff that I've had on, and also getting rid of the junk in my portfolio that has just been horrible underperformers. That we all have some names, especially in the tech space, that are a fraction of where they were a year ago. And you could either play the waiting game to think that sometime over the next years it'll come back, or you could take the loss. If it's in a taxable account, it's a tax loss against other taxable gains. So you can kind of try to wash those out. And that way I raise capital in order to be able to have money available for the next time we pull back to put on some trades. So I'm kind of looking at this as a bigger trading range right now.
Yeah, thank you so much, Rick, for your views on that broader picture. And I know a lot of viewers are here for that broader picture. Quite a few questions regarding kind of debit versus credit spreads and kind of how risk management plays into that. Well, the selection of debit versus credit spreads has nothing to do with risk management. It has to do with our views of the underlying stock itself. So it depends on where we believe the underlying stock can move, how fast it can move. That helps us determine debit versus credit. Notice Moderna, PayPal, when things are at the very bottom, those are a lot of times when we think there's a quick bounce in play. Debit spreads are going to give us a better risk to reward ratio versus when we believe that we're near a bottom, but we're not convinced that there's going to be a sharp rally off that bottom. That's when we lean more towards on the credit side. And some comments about whether or not they haven't seen so many credit spreads. We actually just put out a credit spread this morning here on Allstate. A few questions regarding kind of the DailyPlay today. It is out. You can see it on the mobile app. Allstate is a credit spread that we have for today's market.
Here's a question, Tony. How to trade, or should you even trade the unusual stock option activity, or just stay away from it?
I'll weigh in on my view here is that I'm not a big fan of unusual volume. I think that at best, you're making an educated guess of what someone else is doing. At worst, you're doing something completely different than what someone else is intended on doing or what an institution is doing. I don't particularly see a lot of value in that stuff. It is fun, it is entertaining, but I don't necessarily think it's a great investment strategy.
Okay. Good. Here's one too. Can you explain again the pros and cons of funding of your purchase of a long position by shorting S&Ps? I don't think we talked about shorting them as compared to taking money out of your overall portfolio by selling. We're using S&Ps as a proxy for stocks that you have in there, and hopefully you have S&Ps too, because spiders are one of the easiest ways to just gain exposure for the long run. So even though I have lots of stocks in my portfolio, I also have it filled with spiders, Qs, and IWM, and I've bought them at different times because I've thought that's a better way than trying to go after an individual name. Remember, when you put an individual name into your investment portfolio, the goal and the reason you would do it is because you think it's going to do better than the market itself. If it's not going to do better than the spiders or the Qs, you might as well, for the long run, just be in the spiders and Qs. And you don't have that single stock risk, because if that company ever misses on an earnings report and opens up, sells off 20% in a day, and that's what they're, you see what happens when you miss an earnings report now. You could see the stock demolished. You don't have to deal with that issue if you're in the spiders or Qs. Of course, you won't make as much on the upside if everything goes well. But to me, if you're going to have individual names, you want to think of it as, I'm buying this because it'll do better over time than the market will itself. So when we talk about selling out of some SPYs to fund your option debit, it's really selling out of your portfolio. And these days, whether you have an account at Fidelity or Schwab or wherever it is where you can do fractional shares, you can literally line up what you get out of in order to fund your new, let's say, option play of the day.
Yeah, that's exactly right. Rick, there's a great question here in terms of how did you decide to sell half the PayPal or PAS trade versus others where you simply say, let's take the full profits on? How do you decide when it's time to take half the position off?
It's when I see that we're up against some resistance or we've made some money really quickly. You know, in the Moderna case, we got to the higher strike within days of buying. And we had a pretty wide spread. When you know, on percentage basis, we bought, I think it was a 140 versus a 170. And we got right near there, if not even we shot through it. I don't remember exactly because I know we still have a 150 versus a 175 on. But at that point, I said, like, you know, when you make that money that quickly, then it just, to me, after doing this for so many years, it just makes sense to take the money when it's handed to you that quickly. Yes, you could make a little more if you held it over time, but your risk of giving back, especially in a market that's so choppy like it is, if I buy a 150, 170, and pretty darn quickly we're at 170, there's no way I'm not taking the half off. That's just from years of trading how I look at things. So part of how we look at what we take off has to do with, usually it's not all that much about how many days are left, because we generally try to exit things several weeks before the option would expire anyway. And we don't always do it that way. The American Waterworks AWK that we had on, we took to within a few days of expiration. But there we had bought, if I remember, 145, 155, and we had been hanging out near 155. We took the first piece off when we were trading at 143. No, 153, sorry. So we were getting close to that second higher strike price. That's kind of how I look at things. So it's not a formula per se, but it's part of it's gut feelings, the signals I see in the charts. Are we up against resistance? We could easily stall. All goes into it.
Jay's making more of a statement rather than a question, but saying, can we discuss a losing trade? And there is one that jumps out at me, Rick, that probably stings the most, which is Northrop Grumman,
sure.
Right? Where it was trading near the top end of the range. It looked like a fantastic short, and within a couple of days of entering the trade, the news out of Russia suggested that European nations are going to buy more defense, and the stock shot up from 390 or something around well into the 400s very, very quickly. Let's talk a little bit about that, right? One, this is why we use options to take a short view. This is why I will never, ever use a short the stock. This is why I will never take any type of option strategy with unlimited risk, especially on a short, is because things could go against you very, very quickly. And defining your risk is so important. You can use them to allow so that you can define your risk. And like I said, no matter how quote unquote bad a trade goes, it should not risk more than a certain set percentage of your portfolio. So even if you have a few of these that go immediately against you, you know how much that you're willing to risk, and you know that you're staying within those bounds. And we can talk about other ones here as well, but they all fall under the same category. No matter how good or bad a trade goes, it never risks more than 2% of your account per trade.
Yeah, and look, fundamentals change, and war can do that, or economic statistics, or a company makes an announcement that was not expected, and all of a sudden things change. That is the advantage of putting on spreads. We knew that in the case of Northrop, I think I had looked at the chart initially, and I knew that if it was above 405, that was the top end of the range and kind of a breakout area. I knew I didn't want to be short. So when we put it on, I'm trying to remember, Tony, if we had put on maybe a 398, 405 or something like that. So I was willing to risk $7. On a $400 stock, $7 is not that much. It's a couple percent. No different than if you short a stock at 400 and said, I'm going to put my stop 2% higher. The problem with doing that is on overnight news or something that instantly shoots up a stock, you may open above 408 and all of a sudden your risk is more than the 2% you had intended for it to be. So your buy stops don't always get filled where you want, especially if it's on an overnight gap that makes something just shoot to the moon. Or you're busy on a phone call with a client or something, and all of a sudden, oh darn, I missed where I was going to get out. I had a mental stop. Options give you the advantage of locking that loss to a specific amount that you're willing to have from the moment that you first put it on. And that I agree with Tony. I don't short stocks generally in any. I mean, it's so rare that I short a stock without doing it through an option play as compared to just, doing it outright. On the buy side, we're much more tuned to buying a stock and seeing it go against us. And of course, look, when we think about spreads and options, by using a spread to limit your risk, you also limit your reward. And that's the trade-off. But if you think about this in terms of long-term survivability, is it to be the hero who made a killing on a name, or is it to be able to keep playing that game all the time until one day in life you decide, I don't want to play the market anymore? I'd much rather be in that latter camp so that I'm always here to play the game. And I don't get my rear end handed to me on a trade that just went bad, because it's going to happen, and it's going to happen a lot. That's what trading is. Your goal is to minimize losses, maximize gains, and be around to keep playing the game for a long time. And if you're good at entry and exit, you will do better than the market. And it's not easy. Look, I have some recent statistics that I just saw this week. In 2021, 79% of portfolio managers underperformed the market, right? So that's 4 out of 5 professionals underperformed. And over the 10-year period, 86% of professional money managers underperform their benchmarks. That means only 1 in 6 do. It's not easy to do it, but when most of them don't understand risk management and don't have even the ability to play options the way we do here at OptionsPlay. Most portfolio managers don't do that. So you can do better than the market. You have to be disciplined, and you have to accept losses as a regular part of the game. If you have 2 or 3 losses in a row and you go, oh, these options, I'm never going to play options again. This is just a losing game. No, you just had bad luck. Things didn't go your way for a few trades in a row. That's the way it is. If you have 3 winners in a row, you don't go, oh my God, now let's triple our risk. That's a sure way to be a loser. There's still, Tony, we should definitely do something on this, do another webinar, because once you get me talking, we can go for an hour on just, the things I've seen in my 40 years of being in this game.
Yeah. I usually host a 1-hour session just on trading psychology and risk management. So happy to do that. And we will do that. Chung is asking a great question. When will we have some education on the wheel strategy? Chung, we actually have one coming up on April 7th. Jessica and I are hosting that on the wheel strategy. So that will be coming up. Let's see, there's a lot of questions here. We'll try to get through as many of these as possible. Yes, we will send out both the recording and the slides to you after this session so that you can view this at your own pace. I did go through some of the examples relatively quickly so that we can get to the questions section. Yes, the Ichimoku webinar is available only for members. So you have to be a member in order to access the Ichimoku webinar. That is not available publicly on YouTube.
There's a related question here from a gentleman named Steve. He says, what if the Ichimoku cloud shows a bear signal in the daily time frame? However, the cloud is bullish on the long term, the monthly. Which way do you go? Well, if I'm only trading over the next several weeks, and normally we try something in the 45-day neighborhood as why we're putting on a play, the daily chart is probably going to have more importance to me than the monthly. But the monthly can be important if I'm trying to pick a bottom on a daily or a weekly, and the monthly is also coming down, let's say a monthly 9 down, it's sold off to a TDST line, which is the lowest low in the 9 count in a prior 9 count up. It's at a 50% retracement or some Fibonacci level. The monthly is good to get a sense of what's the big picture, and have we sold off or rallied to a point that in longer term perspective, there may be a place that this stalls. But if we're essentially tactically trading, which is what 6 weeks or less is swing trading. Beyond that, you start getting into medium-term trading. So the 45-day period that we aim to put these on generally, these spreads on, is kind of the sweet spot of the market doing hopefully what you expect it to do. It's why you're putting on the trade in the first place. So when just to give you an example, I happen to have bought Moderna for myself at 132, and I had that as a resting bid that I had put in maybe 2 months ago. When things started getting weak, I picked a level that I saw, and Moderna was trading 200. If we got down there, I'd be happy to be a buyer. And so I used a variety of longer term signals and levels that I thought, if the things kind of fall apart, where do I stick my neck in and buy this thing? But when we put on the play, I know I'm not buying Moderna so that if it's trading 250 next year, we're still holding it, because we used options. We capped what we could make by selling a call against the call we bought, but we got juice very quickly. And generally, when I'm using options, unless you go into leaps, long-term options, we're playing for a move that we see in the market, and we're trading. So I put on some Moderna as an investment and a trade in my own head, but the trade we put on here was, a 140, 170. Percentage-wise, that's a decent chunk. And if we could take that out, we did very nicely, and we have. So it's really the perspective of time versus, trading versus investing. And I hope that kind of answers that. You use different time frames for different type of way of looking at the market.
Thank you so much, Rick. And that is the time that we have here. The market has opened 2 minutes ago. So with that, we will do is let you guys go. We know you have trades to make. So we are thankful for you to join us here this morning. Rick and I will be back to do more of these sessions here on Fridays at 8:45 a.m. to give you, just an update on what we're doing here from the Daily Play research. We are making some changes that are coming out here on April 18th. We will do another webinar before that to announce some of those changes. They're going to align more with what we're showing you here today with respect to, allocating a certain percentage of your portfolio on each trade and kind of walking you through those steps on each of the signals that we send out. So with that, thank you so much. I hope you guys have a great trading day. And like I said, we'll send you both the recording and the slides after today so that you can watch this at your own pace and review them so that the next time you're placing a trade using Daily Play or your own ideas, you can follow some of these principles. With that, Rick, thank you so much for
Tony,
your time
thank
this
you.
morning.
Have a great day.
Thank you. Have a good one.